Welcome to Iron Financial. In this explainer, we are cutting through all the market weakness and all the noise to help you forge a stronger, highly durable portfolio. I'm your lead analyst, and today we are running a brutal, top-to-bottom architectural stress test on a retail giant that has been absolutely dominating the financial headlines lately, Target Corporation. Look, the market has been relentlessly punishing discretionary retail. We all know it. Inflation has been incredibly stubborn, interest rates remain elevated, and the prevailing narrative out there on the street is that the American consumer has finally completely exhausted their pandemic-era savings. So the ultimate question we need to answer for you today is this. In this highly hostile environment, does Target represent a solid, reinforced foundation for your hard-earned capital, or is it a structural hazard just waiting to collapse under macroeconomic pressure? Hold on a second. Before we start pouring the concrete on some massive bullish narrative, let's step back and look at the stark reality here. Target has been stuck in a years-long sales slump. I mean, we all vividly remember that massive inventory glut nightmare of 2022, right? Where they essentially had to liquidate billions in excess merchandise at absolute fire sale prices, completely torching their margins in the process. And let's be honest, discretionary spending is still under severe, undeniable pressure. As the market skeptic today, I'm here representing the viewers at home who are asking the really tough questions. I demand to know, is this Q1 2026 earnings report a sign of genuine, fundamental heavy lifting by management, or is this just a fresh coat of paint on a crumbling wall? Basically, is this turnaround hype, or is it real? And that is exactly what we are going to determine right now. We aren't here for the headline noise, we are here for the actual blueprint. In this explainer, we're going to put Target's entire business model through a rigorous, uncompromising structural stress test. We are going to dive deep into the raw financial data. We're going to inspect the actual supply chain scaffolding they've built, and we're going to closely examine that valuation multiple. By the time we are done here, you will know definitively if the foundation of this retail giant is cracking or if it is primed and ready for a massive multi-year rebound. All right, let's get right into our first segment. We're drilling down into the structural integrity of the business. We need to shift our focus entirely to the core financial load-bearing pillars of Target's first quarter performance. If the top-line revenue is weak, guys, the whole structure caves in. But look at this. Target's Q1 net sales surged by a massive 6.7% year over year, hitting a genuinely impressive $25.4 billion. Let me be crystal clear about the macro context here, because it's absolutely crucial. Wall Street analysts had practically priced in a disaster. They were modeling for flat and maybe even negative growth, assuming that an American consumer drained by inflation would just pull back entirely. Instead, pulling in nearly an extra $1.6 billion compared to the exact same quarter last year proves that Target's structural integrity at the revenue level is holding massive, undeniable weight. And it actually gets even better when we look under the hood. Comparable sales grew by 5.6%, but what's truly structurally sound here is exactly how they achieved that. This wasn't just inflation driving up prices and masking weak volume. No, this was driven by a 4.4% increase in actual foot traffic. Real people are physically walking through the doors again in huge numbers. And this wasn't isolated to just one fluke department either. We saw a broad-based recovery across all 6 of their core merchandise categories. From apparel and home goods to hardlines and beauty, consumer demand re-accelerated across the entire floor plan. Furthermore, this brilliantly illustrates their multi-channel strength. Digital comparable sales surged 8.9%, so they aren't just winning in the brick-and-mortar space. We are looking at a massive 27% growth in same-day delivery alone. This is entirely powered by their new Target Circle 360 membership, which is their direct, heavy-hitting counterpunch to Amazon Prime and Walmart Plus. By offering unlimited same-day delivery, they are effectively locking in consumer loyalty. On top of that, their third-party digital platform, Target Plus, saw gross merchandise volume spike by nearly 60%. Make no mistake, they are building a highly modern, digitally integrated retail fortress. Okay, let me aggressively interrupt this bullish momentum right here. You're sitting there talking about a fortress, but I'm looking at a massive glaring crack in the armor. GAAP diluted earnings per share dropped a staggering 24.5%, falling to $1.71 from $2.27 a year ago. Net income actually declined. You absolutely cannot tell me the foundation is strong when the company is literally bleeding profitability at the bottom line. How in the world do you justify a massive drop in earnings for a company supposedly in the middle of a turnaround? I am so glad you brought that up because we really need to cut through the accounting noise here and look at the actual profit engine. Yes, GAAP EPS was officially down 24.5%, But last year's GAAP numbers were artificially inflated by nearly $600 million in non-recurring legal interchange fee settlement gains. It was a massive, one-time cash injection that completely skewed the comparables. When you strip away that anomaly, when you actually look at adjusted EPS, it surged 31.6% to $1.71. The underlying day-to-day profit engine of this company is actually running over 30% hotter than it was a year ago. So the absolutely crucial point here is that this structural growth is highly calculated. It's not an accident. Look at the category-specific strength. Beauty and essentials are acting as heavy-duty anchors for them right now. Why? Because these are high-frequency consumable purchases that drive reliable, repeat foot traffic regardless of what the economy's doing. To capitalize on this, they are currently rolling out the Target Beauty Studio in over 600 stores this fall. The baby and kids category saw comps accelerate by 5% thanks to brand new, premium in-store experiences. They introduced 3,000 new items in food and beverage, driving 50% growth over prior assortments. And their high-margin, non-merchandise revenue, stuff like the Roundel ad network and those new Circle 360 memberships, shot up nearly 25%. And the true proof of their operational leverage lies right here in the margins. Adjusted operating margins actually expanded from 3.7% to 4.5%. Gross margins improved to 29.0%. And they achieved this expansion despite taking on higher compensation costs and increased marketing expenses. Think about that. They are squeezing more profit out of every single dollar that flows through those registers. This margin expansion is the direct, tangible result of better supply chain productivity and a much smarter, highly optimized merchandise mix. Moving on to segment 2. Let's drill down into the heavy lifting. All right, look, I'll admit the margins certainly look better on paper today, but as we transition to the actual mechanics of this turnaround, I really demand to know, is this sustainable? Are these margins going to hold up? Or is this just some temporary illusion before the macroeconomy forces them to start heavily discounting again? Show me the heavy lifting. You want to see heavy lifting? Let's look at the capital being deployed. Target poured $1 billion into capital expenditures in Q1 alone. That is up 31% year over year. They are not retreating, they are aggressively forging ahead. They are spending heavily to open over 30 new stores this year and executing over 100 deep-level store remodels. And these aren't just quick cosmetic touch-ups. They are completely redesigning the backrooms and the floor plans to optimize for rapid digital order fulfillment. They are physically reinforcing the entire business. And let's move right over to the supply chain because this is where the real structural overhaul is happening. They are pouring concrete into their logistics network. They just opened a massive Houston receive center capable of processing 25 million cartons annually. This facility acts as an absolutely critical buffer between their import warehouses and their store-level distribution, preventing the massive inventory gluts that haunted them in the past. They also opened a Colorado food distribution center to guarantee grocery freshness. And critically, they successfully poached Jeff England, a 20-year logistics veteran from their biggest rival, Walmart, to serve as their new global supply chain chief. Make no mistake, that is a massive strategic acquisition. Okay, I will definitely concede that fixing inventory reliability is absolutely crucial. When an item is out of stock, you're just leaving money on the table and sending frustrated shoppers straight to your competition.
Exactly. And the raw data shows it's working. Inventory productivity turns improved by more than 10%. They are implementing advanced AI to optimize the demand forecasting, which really smooths out the volatility of these erratic consumer trends. But the real masterstroke here is their store as hub model. Over 95% of all sales, and yes, that includes digital, are fulfilled directly from the physical stores. Last-mile delivery is notoriously the most expensive, margin-crushing part of e-commerce. But by turning their existing physical footprint into localized distribution centers, they are effectively neutralizing that cost threat while drastically speeding up delivery times. It's brilliant.
Let's not get entirely ahead of ourselves here, though. Look at what Target's own CEO, Michael Fidelkay, is saying. Encouraging early signs, but we recognize there is much more work in front of us. Even the leadership is telling us to be incredibly cautious. The broader operating environment right now is highly uncertain. Discretionary spending is still under serious pressure from inflation, elevated housing costs are eating into disposable income, and consumer sentiment is rocky at best. Target is highly exposed to those specific macroeconomic headwinds. You can't just ignore that. They are cautious, yes, as any responsible management team should be, but their actions signal immense confidence in their structural integrity. Just look at this upgraded 2026 blueprint. They aren't just crossing their fingers and hoping for the best. They actually raise their full-year guidance. They are projecting net sales growth around 4%. Listen, in a flat retail market where their competitors are fighting tooth and nail just to tread water, 4% top-line growth is a massive show of strength. They expect operating margins to expand more than 20 basis points above 2025. And they see earnings per share landing near the high end of their $7.50 to $8.50 range. A company that is terrified of the consumer simply does not raise its top and bottom line expectations like that. Let's move to our third and final segment, the verdict, forging your portfolio. So, we've tested the structure, we've seen the raw, unvarnished data. Now we have to definitively answer the question, is Target a cornerstone for your portfolio or a value trap? And to do that right, we have to measure it against the ultimate benchmark.
Exactly. If we are really forging a portfolio here, we have to measure Target against its fiercest competitor, Walmart. Walmart has undeniably dominated the defensive consumer spending space over the last year. They are winning with high-income shoppers. They are absolutely winning in grocery. Why on earth should an investor take a risk on a Target turnaround when Walmart is practically executing perfectly right now?
Why? Because of the valuation multiple, which delivers the ultimate value argument for us today. Look at the massive premium you have to pay for Walmart's perfection. Walmart is currently trading at a towering 46 times forward earnings. Think about that for a second. At 46x, there is absolutely zero room for error. One slight earnings miss, one tiny crack in the foundation, and that stock gets absolutely crushed. But Target is trading at a highly discounted 15 times forward earnings. And while you wait for the macroeconomic clouds to clear and for this turnaround to fully manifest, Target essentially acts as a shock absorber for your portfolio by paying you a hefty 3.7% dividend yield compared to Walmart's measly 0.74%. Target just offers immense asymmetric rebound potential. Yeah, but you are paying for risk. Let's be real. You are weighing Target's heavy reliance on discretionary categories, like apparel and home goods, against Walmart's ultimate safety in non-discretionary groceries. It's basic economics. In a recession, consumers prioritize food and shelter, and they stop buying throw pillows and new jeans. If the consumer truly rolls over later this year, Target is going to feel that pain much, much harder than Walmart. That's true, but if the consumer stabilizes even just a little bit, Target's high discretionary exposure becomes a massive tailwind. The recovery upside for Target at a 15x multiple is practically explosive compared to a Walmart that is already priced for absolute flawless perfection. Well, Wall Street remains highly cautious. Despite the positive Q1 beat, the consensus rating on the street is still just a hold. Now, analysts are lifting price targets up to the $140 range, and sure, smart money hedge funds have been quietly acquiring shares in Q4 and Q1. They do that to front-run the recovery while the street publicly says hold. But those lingering macroeconomic concerns are keeping the broader retail market completely on the sidelines. Investors have to meticulously weigh the risk of this turnaround stalling out against that incredibly cheap valuation. And here is the iron financial final verdict. Target has successfully stress-tested its foundation. The top line is reaccelerating, and it's driven by real, undeniable foot traffic. The margins are expanding, they have carefully diagnosed their supply chain cracks, and they've hired the absolute best engineers to go in and fix them. Target is a highly durable structural turnaround, trading at a steep discount, offering a rock-solid income stream for value-oriented portfolios willing to look past the immediate macroeconomic noise. The data is laid out, the blueprint is clear, but the final call is always yours. You have seen the heavy lifting, but you also know the macroeconomic risks constantly threatening the scaffolding out there. So we leave you with this final, critical question to ask yourself today. Do you trust Target's blueprint enough to start building your position right now, or is this 15x multiple a structural failure just waiting to happen? Let us know what you think, and keep your portfolios forged in iron.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.